Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David and Glenn.
Good morning. Let's get to your top stories today. Chinese stocks in focus with the Shanghai Composite surge to a decade high, fueling hopes for a sustainable rally.
Treasuries are also stabilizing after falling for a third day, while Asian stocks are muted as investors look ahead to Fed Chair Jay Powell's speech at Jackson Hole.
And just ahead as well here, President Trump begins arrangements for a meeting between Vladimir Putin and Volodymyr Zelensky after talks with both leaders.
And SoftBank agrees to purchase $2 billion in Intel stock, boosting its U.S. footprint.
All right, welcome to the program and good Tuesday morning. As with the case this time yesterday, in fact, going into the close as well. So as you can see, range bound across the Asia-Pacific benchmark. We're looking at broad weakness, not a lot of it though, just to note that as well across U.S. futures. The Nikkei 225 is coming off a little bit right now, but coming off the still 43.5. As you can see, Taiwan's coming online, the opposite of what we got this time yesterday. And we're in the thick of earnings season, so we talked about the Asia market, Shanghai Composite, 10-year high. We'll get into that in a moment. In terms of earnings coming through today, it's you have some decent names coming through, right? Xpeng, you have Xiaomi coming through. PopMart are also going to give us a really good sort of indicator, really, of the broad-based rally, right, across those big outperforming names as well. Right, flip the page, please, if we can. Dollar index coming up. You have the 10, US 10, Japanese 20-year yield. We have an auction, of course, coming through in about 2.5 hours from now. Stay tuned for that, and we'll see what that looks like as well. Gold futures, as you can see here, slightly to the upside, slightly. I'm being extremely generous there with that description. Right, we are pulling back, as you can see, across Brent. Some catch up, though, when you look at a Shanghai crude contract coming online. Decent move up on Monday, 1% to the upside. Asia equities, though, related to that as well, pulling back alongside, of course, what we're seeing as far as Brent crude goes. Very, very quickly, A50 futures going into the open today, coming up on your screens. The 10-year yield, the 30-year yield as well, very much in focus. You had 178. It's a level we haven't seen, by the way, since early April. We now have a 210 handle on the 30-year yield. And, of course, the Hong Kong dollar has been pulling back from the weekend of the edge. And, of course, the opposite side to that arrangement has been Hibor, right? 50 basis points move to the upside, the biggest single-day move on Hibor. And we'll see what that looks like, again, with that setting today in about 17 years. So lots to watch as we go into the open today, Yvonne.
Yeah, it seems like the HK all these interventions that we've seen, maybe starting to gain a bit of traction now. And what we're seeing in the currency as well as in Hibor rates. But certainly one thing to watch, as you say, it's still about this A-share rally. We continue to watch some key levels here, particularly when it comes to the CSI 300. I think we're within 0.5% of the October 2024 highs. We've talked about the 10-year highs already on the Shanghai Composite. That AH share premium is now at a 5-year low. Will we get to parity? That's one thing that people are speculating here right now as well. CSI 300 there, 42.39 as the level to watch. Earnings, you talked about Xiaomi, PopMart, the like here. Hong Kong unemployment numbers come through later on this afternoon. Of course, we're still tracking that Hibor surge. Maybe we'll see if it has any effect on the property developers here in the city this morning. But it really kind of brings to mind a lot of questions about this rally that we're seeing across Chinese markets. Right now we're seeing the A-share market come and gain its mojo once again. Can we call it a bull market right now? Because certainly the one thing that's really lacking in all this is the retail participation. Perhaps that's why our taking stock in our team over the Asia stocks team there is thinking that maybe this is a little bit more durable because we're not getting that sort of retail euphoria that you usually get when we see these rallies or stuff. But we have a strong lineup in CEOs coming up the next few hours here on the China Show. So we're going to hit every angle really when it comes to sectors here. So the head of Leapmotor is going to be joining us to talk a bit more about the EV sector, of course. If you look at some metrics, they did swing back to a profit, or they swung to a profit, I should say. So talking a little more about the China EV sector, we have Australia's CSL as well. This is the biotech company in Australia as well. Just announced a massive restructuring and spinning off its vaccine unit and announcing some job cuts as well. So certainly one to watch with the CEO. And also the CEOs of BHP and Woodside joining us there in the next 3 hours. Could be pretty jam-packed when it comes to earnings. And for a look at how Chinese markets are shaping up this morning, let's bring in our Bloomberg senior Asia equities reporter Abhishek Vishnoi, and really talking about how durable this rally is. Abhishek, you've been talking to a lot of people. I mean, why is it different this time around, you think?
I mean, it's start of a new cycle. It's a slow grind now after a big bounce, but it's still an upward sort of a grind. And there are fundamentals supporting it. I mean, if you talk about valuations are cheap. If you talk about earnings outlook, it is improving. Tencent, by any measure, if it's a bellwether of listed companies, economy, or everything China, gave you a taste of what is about to come in. But it's not an all-out, a bull market like how we had seen in US. Things are taking shape. Valuations still remain cheap. See, a lot of this is also context. I mean, there is no China in other part of the world, and there is no such a big market with such big heft at such cheap valuations. So a lot of this is in context, and that's why it's working. Having said that, our reporting is showing that there is still a lot of liquidity on the sidelines, especially from retail investors who are yet to participate in. So that sort of gives you a kind of a put option in an environment where yields are low, valuations are cheap in cash equities. Money is expected to come in from them. And it's not just retail. I mean, if you think about the ownership of this China market at this point in time, it's largely, a function of HNIs, hedge funds, and government itself propping up the market. So the long-only money which has started trickling in is yet to come in droves. So, it's both institutional long-term money that is yet to buy into Asia's fully, and it's also retail investors. So a lot of liquidity is on the sidelines. A lot of other markets in comparison to China, they would not have the context of cheap valuations, but other things. A lot of the markets who are cheap would not have the context of earnings or innovation like China has. And a lot of markets which have everything like China does not have its heft. So therefore, it's aptly positioned. Whether A would close the gap with H, well, historically they have, and sometimes they've traded on premium. Yes, they can. But right now, H shares, or the global part of China Inc., is doing much better. I mean, I was looking at MSCI China's best ROE or reported ROE, which is return on equity, and then I compared it with CSI and Shanghai Composite. The ROEs for onshore stocks are yet to improve like we have seen MSCI China. So the onshore part would continue to lead, and A share would continue to trail it for a bit and try and close the gap later. But having said that, this is a durable cycle. And that's what our reporting is showing.
Abhishek Vishnu, thank you so much. In Singapore, of course, you can check out that piece on the Bloomberg terminal today, the makings of a sustainable bull market. Right. The other big story, of course, is what took place in the White House in D.C. overnight. President Trump has now outlined plans for a meeting between Ukrainian President Volodymyr Zelensky and his Russian counterpart, Vladimir Putin. He is calling for a trilat. That's a trilateral summit following that meeting with Zelensky and European leaders at the White House.
The war is going to end. When it ends, I can't tell you, but the war is going to end, and this gentleman wants it to end, and Vladimir Putin wants it to end. I think the whole world is tired of it, and we're going to get it ended.
Let's bring in Derek Walbank, our U.S. economics and government senior editor, with us right now out of San Francisco. Derek, good morning from Asia. Nice to see you, sir. The meeting seemed to exceed most people's expectations. Does it mean a peace deal is just around the corner at this point?
David, I wouldn't necessarily go that far, but it certainly went a lot better than the last time that Vladimir Zelensky was in the Oval Office. It would be hard to go worse, let's be fair, but it did go better here. It was also interesting to me to see that after the summit with Vladimir Putin in Alaska, Trump was saying that the ball was in Zelensky's court. After this one, he's saying that it's going to be a combination of the two of them together. Now, Zelensky comes in to this meeting. It was an absolute crucial meeting here. He's backed in this meeting by a lot of Donald Trump's best friends in Europe, right? Keir Starmer, Emmanuel Macron, Giorgia Meloni out of Italy, some people that Donald Trump quite likes, but who are also big Ukraine supporters. So he had backup there. You could see that Zelensky was taking a very different tone there. He said thank you a lot at the start of that meeting. He even wore something like a suit, which seems silly, but those sort of optics matter in these kind of scenarios. It was something that put off Trump last time that didn't this time. Trump comes out of this saying maybe not a trilateral to start, but a bilateral, Putin and Zelensky to start, and then a trilateral with the two of them plus Trump. You could also see European leaders there trying to kind of jostle in for a little bit of framing on how those discussions should go. One point of the framing was the idea of should there be a ceasefire before we get into serious talks. Trump was pushing back on that, a little bit resistant to that idea, said he'd solve some other crises around the world without needing that interim step. But the other side that they did seem to push on, that they did seem to get some results on, was the idea of a safeguarding force of some kind in Ukraine. Mark Rutte, the former Dutch prime minister, who's now the head of NATO, compared it to a sort of Article 5 style agreement that wouldn't necessarily be Ukraine in NATO. That's not what I mean to say, but that idea of if you move and you attack on one side, this gets invoked and it automatically triggers consequences. That sort of a mechanism, that's what they're talking about here, and that would be something that Russia has not wanted to see. So if they were actually able to get that as a condition for peace, that would actually be a major benefit to Ukraine. At the same time, though, David, we are still talking about some serious potential consequences for Ukraine, including territorial concessions that they have thus far been unwilling to make.
Yeah, I was going to get to that, because if you're going to get some sort of NATO Article 5-like reassurance force, does Ukraine have to budge a little bit in terms of giving up some territory?
Well, yeah, Yvonne, I don't think that anyone's talking about right now in this sort of circle a move towards pre-2014 territorial lines. And that is going to be a major concession for Ukraine if that does wind up coming to pass, because keep in mind, Ukraine has insisted, Zelensky has insisted that they want all of the territory back, even all of Crimea back, as a sort of condition for ending the hostilities. That does not seem to be on the table. The U.S. has said repeatedly, both Trump and U.S. officials, that Ukraine is going to have to give something up in terms of land. There's talk about freezing kind of near the lines as they seem on the battlefront right now. The difficulty is that what is going to buy you actual peace? What is going to buy calm? What is going to buy an opportunity for Ukraine to be able to rebuild without the threats of missile strikes night after night after night, and civilian apartment complexes bombed, and all sorts of other atrocities that they've been living through for years now? What does it take to get to that line, and what sort of strength is required for the assurances that Russia won't just break this a couple years later and go through? That's in the mind of Zelensky, and when he's talking, I think, about, what might have to be given up, it's what do you get on the other side. And a lot of this meeting, to me, was about trying to make very explicit what you're going to give back. Remember, last point, key point, though, throughout the Trump administration, second go round, we've been talking about what is the U.S. guarantee here in terms of security. There have been big question marks. I think a lot of European allies are trying to take those question marks and turn them into exclamation points that everybody around the world can take to the bank.
Derek, thank you. Our U.S. Economics and Government Senior Editor, Derek Wallbank, joining us out of San Francisco. Coming up, we're going to have HSBC Asset Management joining us to walk us through what to expect out of Jackson Hole. The head of Asia Fixed Income, Elizabeth Allen, joins us a little bit later on.
Right, welcome back. 14 minutes to the cash market open in Greater China. We're looking at bonds specifically as well. So in about 2 hours or so, we'll see what that bond auction looks like. The last time we were talking about the 20-year in Japan was a consequential moment, if you think about it. 10-year yield, I think we are up for 2 or 3 days now, 432. Certainly we're steeper on the curve there. That's ahead of Jackson Hole, and certainly how non-committal but committal will Jay Powell remain. And the 10-year yield in China, as with the 30-year yield, are at levels we haven't seen in about 3 or 4 months now. So this melts up in yields continues in the CGB market. Dollar on your screens at the bottom, slightly on stronger footing. Right, let's bring in our first guest this hour. Hibor. Elizabeth Allen, head of Asian fixed income at HSBC Asset Management. Good morning. Nice to see you.
Good morning, David. Good morning, Yvonne. Very nice to see you today.
So the big event in fixed income markets will be Jackson Hole, Jay Powell. What do you think he's going to tell us about the rates outlook?
Well, that's a very difficult question that you're asking me. I think thinking about rate cuts is what we kind of discuss and think about a lot every day. Looking at recent U.S. data releases, the chance of a rate cut probably has increased. We see the market is pricing in a 25 basis point cut in September. We think the way to think about it is it's very hard to pinpoint the timing. We've seen that in the last 2 years. So we would like to take a slightly medium-term view.
Okay.
And our house view is for the U.S. Treasury to have a Fed cut of 2 to 4 times in the next 12 months. So while the timing is not easy to pinpoint, we do see the beginning of a Fed cut coming, and that's imminent. And that's kind of good for fixed income.
Tell us a bit more about what this means for, how the Fed's going to approach, the tariff impact doesn't seem like it's showing through too much right now, but labor market is showing signs of maybe cracking now. You think that they can see through some of this inflationary impact from tariffs and move forward?
Yeah, we certainly see that labor market data, the revisions that we're seeing, is showing signs of weakness. Inflation is kind of a bit sticky. It's yet to be seen. So far, the tariff impact hasn't really shown through in the numbers. We do think that could be possible, and I think that's the difficulty the Fed is facing. So back to your question of Jackson Hole, I think there's a lot to watch, and we'll see what Powell and the rest of the governors might have to say.
Can we assume that the steepening trend continues?
Yeah, we do expect the steepening trend to continue. Should there be a rate cut, the front-end rates would come down. However, looking at kind of long-term trends, right, the U.S. external deficit, the institutional uncertainty will continue to kind of make the long end of the curve a bit elevated. So, yes, we still see a steepening trend there.
And the dollar, can it continue to drop from here?
Well, the dollar has been on a downward trend since the beginning of the year. It paused a bit in July and continued that trend in August. We do have a weak dollar view. The concerns over institutional challenge, the convergence of interest rate with the rest of the world, and also the convergence of kind of growth rates with the rest of the world, we think is likely to weigh on the dollar. Again, as we know, when we have a weak dollar situation, is actually beneficial for emerging market assets and also beneficial for Asia assets.
You've turned more defensive, I understand, very recently. Tell us why and how are you expressing that?
Yeah, we have turned a bit defensive since the summer. That is in view of the expectation of weaker growth prospect coming in from the U.S. and the rest of the world. Having said that, we think it's still important to stay invested to benefit from the carry rate. While rates are coming down, locking in the interest rate at this point is still what we suggest our clients to do. Staying invested, however, going up in quality is what we think will benefit for a diversified investor.
And where in Asia are you finding those opportunities? What strategies work right now?
We are still focusing on kind of pan-Asia strategy. There are a few reasons for that. One, we talk about kind of slower growth in the U.S. and the rest of the world. The growth rate in Asia is still superior over many countries. That's one. Also, if we look at the fundamentals of the issuers in the market, they're actually having very strong balance sheets, very good credit quality, and this year we actually see credit rating upgrades outpacing downgrades. So that's something to be aware of because we talk a lot about tariff and the kind of negative implication, but we look at credit fundamentals, they are still very solid. And thirdly, by definition, investing in a pan-Asia strategy will give you a diversification. And in the kind of uncertain world that we are facing today, having a diversified portfolio positions is very important.
All right, Elizabeth, we gotta leave it there, but thank you so much. Elizabeth Allen of HSBC Asset Management joining us here in our Hong Kong studios. Pre-market just opening up. Looks like we are set for a extension of this rally that we're seeing in Chinese markets. Of course, Hang Seng is up about a fifth of 1%. Futures are in the green here this morning, and yields are ticking just slightly lower by 1 basis point in your Chinese 10-year. Putting more ahead. This is Bloomberg.
Good morning. Welcome back to shows. We're looking at a couple of things. You know, we talk about this. Are we in the early innings, or maybe even further on, is a sustainable bull market in mainland China? So turnover actually yesterday, this is interesting, right? 2.7 trillion. In context, that's the third biggest daily turnover on record. The last two were about 10 months ago, October 9 and October 10, I believe, of last year, following that PBOC briefing. So we're keeping an eye on this, obviously, given the fact that market activity has been picking up. Southbound flows yesterday weren't quite as robust as the day before, so I guess we can get to that in a moment. But yes, we also have some breaking news, I believe.
Holding off on that for now. Let's take a look when it comes to what the free market is looking like. Looks like we're pointing to gains here right now. The pre-market is up about 0.25%. Of course, we talk about these earnings. Goldman Sachs has a pretty interesting line about anti-involution and what could actually benefit from it. So CATL, Medea are some of the names that they think could get a boost from this as well. Earnings that we have to tell you about as well when it comes to this Tuesday. So it's the X's, right? Xpeng, Xiaomi. Yes. You talk about Pop Mart, some of the big consumption names really that we need to deal with and talk about here today. So certainly there's a lot of the biotech space as well, Wuxi Bio, Ping An Good Doctor, Sunny Optical. So there's a big list to kind of chew on the next few days.
I mean, just to mention Ping An Good Doctor, right? We did get an upgrade as well on one of its peers, Alibaba Health. Actually, I think getting an upgrade from Macquarie earlier on. So obviously the space is doing very well. So we mentioned breaking news. S&P has now affirmed, or is affirming, their current rating on the U.S. credit ratings here, AA+, A1 minus. Outlook is still stable. You probably see that already on your screens right now. But yes, the affirmation of things remaining the way they are, let's put it that way there, out of S&P on the U.S. economy.
Yep, so I'm getting a little bit of the overview there. So 7 months after assuming office, the Trump administration has gained congressional approval of a signature tax and spending bill, so reflecting key policy priorities, and continues to overhaul the international trade regime. But we expect meaningful tariff revenue to generally offset weaker fiscal outcomes that might be otherwise be associated with this recent fiscal legislation. That's why. But what drove that hold when it comes to that rating as well? We have plenty more coming up. This is Bloomberg.
Right, good morning. And you're watching the China Show. It's a big earnings day today, as Yvonne is pointing out, right? The excess. No, nothing romantic there, by the way. So we have Xpeng, we have Xiaomi coming out, among many others. Southbound flow is not too much in focus today. This big jump in Hibor, there's going to be, I think, something to talk about as far as Hong Kong markets are concerned. That gap, of course, in A&H, and really as far as turnover goes, Yvonne, lots of things to discuss. Particularly CSI 300. We'll see whether we get to that specific milestone today.
Yeah, we're just about a whisper, a whisper. I don't even know, 0.5% away from the October 2024 highs. So maybe we'll see. Maybe it really catch up with what we've been seeing with the Shanghai Composite as well. So A-share market rally is certainly one thing to watch. And we were just talking to our Taking Stock team about, is this kind of the workings of a durable bull market right now? That certainly is one question that we come to mind when we ask about this. But it seems like we're still pointing to some decent gains here this morning. The A-share market is looking like this. We're up about 0.1%, mind you, here right now. So it's pretty slow going here as we talked about, this rally has been slow. It seems like, you take a look at what authorities are. They are maybe enjoying the fact that this is a very slow sort of churn in equities, because it then builds the sort of wealth effect that hopefully does boost consumption, right? That seems to be the narrative that we've been talking about a lot as well. Bonds are slightly bit up here this morning, though. We have been talking about this melt up in yields. That's taking a bit of a pause button here today, but we're still talking about 210 levels for your Chinese 30-year yield. We're watching CATL shares in particular. Goldman coming out with a pretty interesting note saying, if you want to look for names that benefit from anti-involution, it's the likes of CATL. It's the likes of Medea Group that they are highlighting there. Medea shares, there you go, are up some 2% in the A-share market. Let's look at the boards, though. We talk about earnings. That's certainly the big one. Xiaomi, Xpeng. Those are the big ones. PopMart as well. If you're long Labubus, that certainly is going to be the one to watch in terms of the explosive amount of growth that we're seeing internationally when it comes to that doll. Hang Seng is up about a tenth of 1% right now. HS Tech, though, is selling off a little bit. So we're seeing that with Baidu, Meituan, Xiaomi, just marginally, though, slightly to the downside here. Property is interesting, right? Hibor rates have been shooting up. We saw the biggest move in 17 years yesterday. Hang Seng Property is actually up about 0.9%. So certainly that's one thing to watch here as well, whether there is that sort of cause and effect here right now. Honky dollar, though, at 780 levels. So it looks like we've come off some of the weak ends of the trading band here as well. But yes, because of that Hibor rate, seems like that HKMA intervention is now seem to be working its way into the system. 718 for dollar China here right now, Dave.
Okay, yeah, one stock we're tracking, as we were just pointing out there, very closely today is, well, shares of Leapmotor. A couple of things, right? So yesterday we had a preview piece on this. Share price is up north of 200%. Point number one, we're a little bit down right now in the early minutes of the Tuesday session. The financial metrics which the company reported on the right side of your screen, so everything from revenue, 24, operating loss still, but when you go further down the income statement, pre-tax profit on a GAAP basis, that's actually turned black, 33 million there. EPS GAAP, positive 0.02. EPS from continuing operations adjusted negative 0.02. We're also getting analysts coming out and upgrading the price targets for the stock, and it seems that the company is delivering. The latest one to come through that I see on my screens is JP Morgan raising their price target for Leapmotor on the back of strong results here. They do expect further upside in the share price. Joining us now to talk us through the company's results, the performance, and the outlook is the company's co-president, Michael Wu, joining us from Hangzhou this morning. Michael, good morning, and thank you for taking the time to join us today to talk about the company's performance. We understand that given the strong tailwinds and momentum in sales that the company's raised its sales target for the year. I wonder if you could clarify that for us at the onset, Michael.
Yes, good morning. Thanks for having me. We've had a quite good result. As we always been saying, we're in the long-term business and we're on track. So as you pointed out, the second quarter and the first half, we actually turned a significant milestone to turn the profitability. And also our sales volume, 221,000 in the first half. That's over 150% growth, ranking the number one among the startup peers for the first half. And also sales in July, we achieved more than 50,000 sales volume. Again, ranking number one among the startup peers, being the fifth consecutive month achieving that number one. And the revenue growth more than 170%. We're both operating cash flow, free cash flow positive, and not only positive but also a significant growth from the last period. So gross margin also quite healthy. We average gross profit margin was 14% for the first half, compared to that we barely turned positive in the last year in the same period. So based on the strong performance, again, we're on track for the whole year. We have upgraded some of the projections. Sales volume, we upgraded from 500 to 600,000 units to now 580 to 650,000 units for this year. And we'll maintain the path to have the quite reasonable gross margin, around 14% to 15%. Again, for the whole year, we target to achieve profit in the range of 500 to 1 billion RMBs. So we're on track.
Okay, on track.
Wow.
I mean, you made 30 million RMB in the first half. I'm just wondering if you're talking about 500 million to a billion. When can you actually transition to long-term profitability, Michael?
Yes. Again, being on track is the way we achieve long-term profitability. Okay. For 2026, we will target to sell more than 1 million cars in total. And by 2027, we would target to sell close to 2 million cars. So we're executing along that path. And with that, obviously, the profitability will improve, given our business nature being high operating leverage. So for 2026, the profitability could be in multiple billions in RMB. So again, we're on track.
Okay, yeah. Well, just to recap that, Michael, wow, these are very big numbers here. So 1 million is the sales target for 2027. Correct me if I'm wrong, by the way. 2 million for 2028. How are you then, 2026, how are you aligning your production capacity then to be able to then reach those goals if demand, of course, cooperates?
Yes, we plan our business alongside in terms of production. By end of this year, we'll have the production capacity more than 1 million units. So it's always being planned in parallel.
Okay, I'm just wondering, there's a whole government campaign now, Michael, that is talking a little bit more about how to end all this crazy competition in the EV space here right now. Maybe can you talk a bit more about anti-involution, this drive here? Does that change your pricing strategy in any way?
No, actually, this, as you mentioned, this new, guidance or the new industry self-constraint, way, which is good. To make sure, while the competition being fierce, we don't go from extreme to this extreme to the other extreme, which is quite healthy in the long term. So in terms of our strategy, it doesn't change anything, because we produce products, we bring the product to the market with a very good feature, very good value to our targeted consumers. At the same time, as we grow our volume, as we grow our gross profit margin, we also continue to drive down the cost, leveraging on what we do the best, which is we have a fully vertically integrated business model with all the key electronic and electric parts and components. We're the tier one suppliers to ourselves. So we do all of this in parallel, and the price, our pricing allows us to have, as we mentioned, double-digit gross margin, yet can provide the best, competitive products to the industry. So I guess it's about competition and competitiveness rather than kind of unhealthy competition.
Right, Michael, and not that it's to your point, right? You're controlling what you can control, which is the product, and you're looking to increase your gross margins to the point you just made. But surely, in some indirect manner, how your competitors' price will affect whether or not you can reach your targets. And I mean, that's just to ask whether you have observed any changes in behavioral strategy among your peers or yourself because of the government campaign that's going on.
I think you will see a diverging trend, right? For certain companies, you would have pressures. For our companies, for example, we bring the products in the 120,000 RMB range in the case of our B10, 140,000 RMB price range in the case of C10. These are the best class products with a fully loaded, good range technology, autonomous driving, all this stuff, yet we're achieving healthy gross margin. So in our case, we go and adapt to the market force. But in the meantime, we try to leverage on what we do the best. So I think in our situation, we would consider ourselves on the right track, adopting the right strategy, doing the right behavior in the industry. So that's why we're pretty confident in this.
The auto sector has certainly benefited from all these consumption subsidies we've had from the government, Michael. I'm just wondering, now that things are going to be phased out a little bit on that front, are you concerned about any slowdown in demand in the foreseeable future?
we're not concerned about that. I understand in the industry, some people are raising issues about the slowdown of the demand in the next year because of the phase out of certain government policies or subsidies. That may be true. That could have near-term impact to some companies, but we're confident in the overall broader economic policy package that the government will roll out. If you're aware, the government is very much focused on promoting the economic GDP growth, consumption. They will come out the whole package of different things. If one particular policy, for example, the purchase tax, is reduced, but at the same time there are other policy measures, tools in the package will keep supporting the consumption, supporting the GDP, and supporting the car industry. So, and also on top of that, we as a company, we're very uniquely positioned given our strength, our technology, our capability, our cost control, our execution of our strategy. So going to next year, as I mentioned, this is a long haul game. So we're on track.
Yeah, and one of the things that I guess separates you from the rest, Michael, is that you are very vertically integrated. You manufacture and develop a lot of your components and the like in-house. I have to ask you then, when it comes to batteries, for example, have you been able to benefit from some of these lithium prices coming down?
Yes, industry-wise, the lithium resources price has been down. It's been there for a while. And given the cutthroat competition nature, battery makers, the cell makers don't have a very high profitability margin anymore. So, we're all in the same boat. But that's not the key issue. Even if the lithium resources price start to move up, there's still a way for us to manage for the overall cost structure, the business structure, the overall strategy of the things. So this is a very much holistic thing, that involves so many pieces in our business.
Michael, talk to us about your overseas plans, whether that's what your revenue targets are, if there are new ones there. And of course, I understand you also have some localization plans in terms of capacity in Europe, and I wonder how far along you are on that decision.
Yes, overseas, we're on track too. 25, our target of sales is 50 to 60,000 units. And in the first half, we sold about 20,000 cars, and making us one of the biggest in startup peers. And also, overseas, we have about 600 point of sales, working with the Stellantis group, which is a great partner. We have 600 point of sales shops, 550 of them in Europe, 50 of them in the rest of the world. And also, as a localization, we have started the planning, processing. By mid of next year, we hope to settle down on site selection, preparation of the local production in Europe. In addition, we have a small production site now in Malaysia, in the Guruan. The first car of the C10 just rolled off the production line last week in August. So we're doing all of this.
Have you shortlisted any locations, Michael? Do you have any locations you can tell us?
We're discussing with multiple countries and governments, also working with the Stellantis. But right now, it's not really final yet. So we'll hope we'll get that pretty soon.
Right. Michael, speaking of discussions, maybe if you could set the record straight, lots of people are talking about Ferrari. What exactly is going on?
Our partnership with the Stellantis group is full scale. We work with all parts of all brands of the group. We'll try to identify any potential collaboration things. Yes, Ferrari, the CEO of the chairman of the Stellantis group visited Hangzhou several times, bringing their top managers from various brands. Ferrari, yes, but right now we don't have any particulars to disclose because things are being discussed, but it takes time or to materialize, or some may materialize, some so.
All right, Michael, we got to leave it there, though. Thank you so much for your time. Michael Wu there, co-president of Zhejiang Leapmotor Technology. We got plenty more ahead. This is Bloomberg.
Right. Welcome back. Xpeng is reporting earnings today. We're up 64%, as you can see here today. It's suffice to say, it's done quite well, certainly off the highest of the year that we hit pre-Liberation Day. For a preview of what to expect, let's bring in Linda Liu, our Asia transport reporter. She joins us now to talk us through this. So, I mean, the company is targeting to break even in 4Q. How is that progress? Because I think we've been talking about Xpeng breaking even for some time now, Linda.
Yeah, so actually this year they've been going on a strong momentum. Sales has been on a tear. A lot of that driven by this really affordable and stylish looking sedan called the Mona 03 that they've launched, which is really popular. They're also narrowing their losses from stronger cost controls. So overall, I think analysts are quite positive on Xpeng's ability to achieve break even in the fourth quarter.
They're also wrapping up global expansion, Linda. Tell us more about that.
Yeah, Xpeng launched its flagship model in the Indonesian market recently, and they said that this model is going to be manufactured locally in this production they've just set up. So that marks a milestone for their overseas production. They're definitely assessing other markets as well, as they've said. Key markets like Europe is one that they're really assessing how to expand their presence in as well. Their global partnerships with other manufacturers, such as the partnership with Volkswagen, is also gaining traction. Recently, Volkswagen announced that more of Xpeng's technology is going to be incorporated into their internal combustion engine lineup, as well as plug-in hybrids. So not just for EVs, you're going to see Xpeng technology powered cars from Volkswagen more and more in the China market. So all of that is going to help with driving up, hopefully, their margins as well as their global presence.
Right. Now, this is something that came up in our earlier interview with Leapmotor. Certainly the increasing capacity overseas more than domestically. How is that playing out right now in this earnings season, Linda, generally speaking, so far?
Yeah, we've seen a research group, Rhodium, actually just published a report looking at this trend, Chinese EV supply chain companies and their investments. And they noted that actually in 2024, Chinese firms invested more overseas than they did in their home market. So that marks quite a historic shift. And so the research report said that this reflects a trend of just intense competition in the home market has led to this erosion of profits in home, as well as an overcapacity that really suppresses their earnings. So Chinese firms are increasingly, looking to overseas to really try to capture new customers as well as higher earnings. So a lot of that overseas investments is driven by batteries. Actually, we've seen the likes of CATL building new factories in Europe, as well as other Chinese companies. So that's going to be a really interesting trend for the Chinese EV industry to come.
Linda, thank you, Linda Liu there, our Asia transport reporter there. And tomorrow, of course, on the China Show, we'll have Xpeng's Vice Chairman and President Brian Gu take us through their earnings and really what's ahead for the company, and really talk to the man himself about all this growth that they're seeing as well. That's going to happen at 10:30 a.m. Hong Kong time.
Right, welcome back. We're looking at the rare earth space on the back of these. I think we're looking at a pickup in exports and shipments right now out of China. Nothing much to note there as far as that is concerned. We're looking at milk and dairy stocks as well. I believe on the back of this extension of these probes, there we go, into the good stuff coming in out of Europe. And as you can see, of course, the local and domestic players are feeling the tailwinds there. Asian defense stocks also in focus given the progress that we've made overnight, and let's see where we go with the sort of Ukraine-Russia conversation right now. And the meeting certainly did go better than most people had expected it to go, but certainly it's still, how does that inform us, though, of really where this is headed eventually is the key question there.
Yeah, have we really kind of laying the groundwork for some sort of peace deal, or did we just see some sort of strategic reunification of Ukraine and its allies in some ways, right? So certainly we'll watch very closely if, in fact, we see some sort of trilat between Trump, Putin, and Zelensky in the coming weeks or months. But yeah, there you go. Markets are doing this here right now. So Hang Seng is not doing as well as the SI 300. We're getting very close to those 3-year highs for that benchmark as well.
Yeah, I mean, it's the only flirting we can do these days. CSI 300
for me and Dave, at least.
Is flirting with 2022 highs. We'll talk about that. The next hour of the China show is just ahead. Do not go away.
Welcome back to the China Show. Here's a look at the CSI 300, a half hour into the session. We continue to extend some gains here, and we are now flirting with those 3-year highs for that benchmark. Of course, after the Shanghai Composite reached the decade highs yesterday. It's a beautiful day in Shanghai here today. Much better than what we're seeing here in Hong Kong, Dave.
Yeah, playing with our feelings.
Rubbing it in all the time.
All the time, right? And I don't think I've forgotten how the sun looks like, in fact. So in case you missed it, I think an amber rainstorm warning has been hoisted over the city.
That's nothing.
Oh, yeah. Compared to what, and hopefully it stays that way, right? Yeah. It got pretty bad the last few minutes or so, in fact, so we're going to thank our next guest who's coming on very shortly, who found his way into our studio today, despite, of course, the weather out there. Flip the boards, please. Hang Seng China, where you have, in terms of points movers there, you have financials to the upside. Tech is the drag there. I'm looking at my screens. We're looking at Xiaomi, Tencent, and Meituan are the bottom three as far as points go. Construction, Agbank, and Bank of China. In fact, the big four are actually the counterweight there. Shanghai Composite, as you can see, is still building on the gains from yesterday, further 10 points on top of the already 10-year high close that we had on Monday. Leapmotor, we joined us on shows early on, of course, the CEO talking about they've effectively raised their sales target for the year, and they're coming out with some pretty aggressive targets in the years to come here, given how they basically see they're profitable now. Yeah. Sustainably.
Well, they were able to swing to profit here for the latest results, and certainly they've been talking about these numbers from, I think it was 580,000 to 650,000 was some of the targets that they outlined during their earnings call as well. So certainly that's one thing to watch. Also, when it comes to 1 million in 2027 to 2 million in 2028, those are some of the sales projections that they were expecting as well. So that certainly is one thing that they're seeing, is maybe this growth momentum can be sustained. They're not too concerned about the slowdown, the possible slowdown in demand as well, given some of these subsidies might be fading out later on this year. Yeah,
not a big issue as far as they're concerned. We have some breaking news right now. We'll have more on this, by the way, in a moment, in a couple of minutes here, but we understand that Shein has weighed or mulled or considered moving back to China to ease the path towards, unsurprisingly, an IPO here in the city. We'll get more details on this Bloomberg scoop a bit later on in the show. There,
yeah, certainly could mean that in more tailwinds coming to the IPO market in Hong Kong. We've been waiting for some of these big names like Shein after, of course, they tried to attempt for a London listing and the like. So certainly that's maybe one of the next few names to really look out for. But yeah, it's that certainly is one tailwind. And then you keep talking about this A-share market rally, where it seems to be we're laying the groundwork now for some sort of sustainable bull market. That's the key question, if it's actually durable.
Yeah. Turnover's picking up. I think margin debt is already back at
2015 levels.
2015 levels, right? The last time we saw that, 2015 levels on the Shanghai Composite itself. In fact, I think the turnover that we had yesterday, I think we have a graphic that shows you this, if it's not going to come up later, 2.7 trillion on Monday. Yuan was the total turnover for the day. That's the third highest daily turnover on record. The previous 2 days were in October of last year. So interesting pickup here.
Yeah, it's interesting, too, when you talk about the makeup and the characterization of this rally, is that retail investors have not really participated. And you got to ask why, right? And you take a look at how ETFs are. Seems like they've actually seen 8 weeks of selling of some of these equity-focused ETFs and actually inflows into bond ETFs, for example. So is that a good or bad thing for the market, that you might not get that sort of retail euphoria that we once seen in some of these rallies?
Well, imagine
would be a good thing.
Well, imagine if they come in then,
and then what happens?
And then what happens there? Great context text coming through out of Chinese media this morning. In fact, one of the top headlines there in Chinese media today. Here's a quick look at how that's being framed as well. Front page report on the Securities Daily says the rally has drawn funds from a diverse pool, including household corporations and overseas investors.
Yeah, the paper cites exchange data showing more than 14 million new retail accounts were open on the Shanghai Stock Exchange from January to July this year. It also says long-term investors like Central Huijin and insurers are expected to ramp up market exposure.
Yeah, and someone who cannot contain his excitement with the rally going on right now is Hao Hong. He joins us here in set, managing partner, CIO at Lotus Asset Management. It's been doing well, this market.
Very well.
Can it continue?
More likely than not, it's going to continue because, right now the retail money is not coming in just yet, right? So right now it's mostly institutional money. And also, this year, if you look at how the retail deposits in the banking system has been rising, right? So year to date, we have more than 5 trillion yuan new deposits coming in from the banking system, right? So that sort of bodes well for the liquidity in the market. And I think normally when a bull market happens, firstly you have the institutional guys coming in, and then towards the second half of the rally, then you will have the retail money participation. And right now we're not seeing, probably 20% of the market is retail money, so the retail money is not participating at a very mass scale, and therefore I think more likely than not the rally would continue.
Should we be concerned that margin debt is back to levels that we haven't seen since 2015 then, right before things collapsed?
I think we should feel encouraged to see margin debt rising. The reason being, for the longest time, we haven't seen this kind of risk appetite coming back to this market. And if you look at, official numbers, for example, Chinese consumer confidence is still at, decade low, right? So it hasn't rebounded since 3 years ago, since we come out of COVID.
Yeah.
So, for the market to rise further, we must know that, firstly, there's no fundamental support, right? So fundamental is really bad. And I think the market is betting the authority to come in to sort of execute some sort of stimulus policy like it did in last September, and to sustain the rally. And I think right now, the sort of the calculation for the authority really is that, because the property market is so bad, and we need some sort of an asset price rising to sort of pull the consumer confidence out of the valley, right? So out of the low point, and so therefore, I think come September, October-ish, then we should see some more details on policy front.
Is this also a chase for yield? We've talked about how insurers are going into the equity market as a big buyer there. We're seeing this recent melt-up in bond yields, and I wonder where people are. Do you think investors are switching from fixed income back into the equity markets?
Well, at least, right now, if you talk to the fixed income guys, right, so they call themselves fixed income plus fund manager. Okay. Right? Yeah. They want to re-identify themselves as an equity.
Cross-asset.
Yeah, so you can see, how bad it is for those guys. So, the bond market has been rising for like 3 years now, right? So they had a tremendous bull run. Chinese long-term bond yield is still at decades low. Okay. So therefore, I would say that we would continue to see money rotate from bonds to stocks.
Tell us, you mentioned that this rally can actually broaden a bit, right? Are you seeing it spread out beyond just the mega caps right now?
I think so.
And the banks.
That's right. So in the first half of this year, right? So we did have a bounce because of DeepSeek. And back then, if you look at the names that is rising, the Tencent, Alibaba, and the like, right? So those are very familiar names that people are very used to. But right now, every day you're seeing very strange names coming up, some names that you've never seen before. And also, if you look at the new tech board, the Beichuan Wuling, and also the China export, they're rising substantially faster than the main board. So that is telling you that the rally is actually spreading out.
Can liquidity alone be enough to fuel this even further? Or at some point, we'll need to look at fundamentals. And do you think at that point fundamentals will slightly be better than the current state? That's right. I would say that liquidity can let you go so far, right? So, right now we are very close to 3,800 points, a level that we haven't seen for 10 years. So Hong Kong is closing in 26,000, also a level we haven't seen for 10 years. So I think, from here onwards, for the rally to sustain much further from here, then we really need to see some policy support, because if you look at the fundamental, there's no reason for you to be bullish on this market.
What about earnings?
Earnings so far has been resilient, I have to say. Right? So even though the larger cap names, giving some sort of mediocre performances, but I think if you look at the smaller cap names, they're actually giving very good results. And also if you look at the names, the earnings, the stocks that's been doing well this year, right? So new consumption names, for example, the CXO names, and also some of the robotic industries that we haven't seen before, that is sprouting up this year as well. So this rally is actually it's being led by many of these new sectors that we haven't had before. And if you look at the past boom markets in Chinese history, right? So every boom market they will have a leading steers, to lead the market up. So in 2007, it's the big banks and big financials and big SOEs. I think in 2015 it was the China export, and I think right now we're getting into an era where we see the new industries that probably have a very low representation in the index, but their earnings is actually rising. Their importance and also they're occupying investors' focus, and I think more likely than not, this bull market will be continued to led by these names.
What do you think of biotech? I mean, you mentioned there are new sectors that are leading the rally that we haven't seen, and biotech's been a fantastic long this year, right? Yeah. Do you think that continues? Do you get questions around this?
Yeah, I would say that this sector should continue to do well. Reason being, well, if you look at some of the names, they're up like 10 times already year to date. It was just phenomenal. And I think reason being, these names have been really beaten down in the past 2 years. People just sort of written it off. But then come this year, people starting to see the R&D efforts that they spent in the last couple of years is coming to fruition. Right? So many of the biotech companies actually giving out good results, and some of them actually, forming joint ventures, being acquired by foreign players and all that. So that is telling you that, this sector is actually, sort of coming back to life. And also, China actually have a comparative advantage in this sector in the sense that the cost is really low. Right, so the cost to do all sorts of experimentation is very, very, very low for Chinese companies. And so I think all in all, one shouldn't be too surprised to see, because this is a new sector, it aroused the imagination in people, and shouldn't be surprised to see, this sector continue to do well.
Sorry, very quickly, one last thing. The pickup in Hibor this week, does that have any lasting implications, you think? I think we were up the most in 17 years, something like that on Monday, from a low base.
Yeah, very, very low base.
Yeah.
And also is, the money that is coming from mainland and also some fund flows coming into Hong Kong from overseas is making the HKMA's life difficult. Right? So I think many of the investment banks in Hong Kong is actually offering people some structural product to take advantage of the situation where you're still seeing a huge interest rate spread between US dollars and Hong Kong dollars. So because of that, there has been selling pressures on the Hong Kong dollars, and now people sort of coming back to senses. And so people shouldn't be too sort of concerned about the surge in Hibor.
Hao Hong, thank you so much. Managing Partner, CIO at Lotus Asset Management. Coming up next, the former U.S. ambassador to Ukraine, and we're talking about the other big story, of course, with Russia here, joining us to really take a pulse check of Trump's peace plans as he floats the idea of a trilateral summit between the U.S., Ukraine, and also Russia. That's coming up next, plus plenty more. This is The China Show. Good morning.
Well, President Trump has outlined plans for a meeting between Zelensky and his Russian counterpart, Vladimir Putin, and a trilat summit with the U.S. after that. So that's what came out of that Oval Office meeting. Joining us now is William Taylor, former U.S. ambassador to Ukraine and currently a distinguished fellow with the Atlantic Council's Eurasia Center. Ambassador Taylor, thank you so much for joining us. So they're talking about the prospect of a trilat now. Do you think we reach any sort of breakthroughs towards some sort of peace deal after this meeting?
Yvonne, I don't think we're at a breakthrough point yet. I think there's a lot of work that's gone on. They had a lot of good discussions today, both with President Trump and President Zelensky, but also these European leaders who were eager to come to make the point that this conflict is not just about Ukraine. Yes, it's about Ukraine. Of course, the Ukrainians have been holding off the Russians now for 3.5 years. But the Europeans were also there because this is about European security. The Europeans really want the Ukrainians to be able to stop the Russians in Ukraine, so that the Russians are not a threat to the rest of Europe. So this was an important meeting for the Europeans to make that point too.
Ambassador David here. Yeah, I mean, you bring up a very good point. It doesn't seem like any side wants to share a border with any side, which is, we know can't happen because at some point, that's going to meet. But the reason I bring that up is I think the topic of territory and whether or not that's on the table as far as discussions go will be discussed at any future meeting. Do you think that's a red line still for the Ukrainians, ceding any territory to the Russians?
David, I think it is a red line if we're talking about formally ceding territory. The Russians, of course, want the Ukrainians and the Europeans and the Americans to formally recognize that they own parts of Ukraine that they now occupy. They want the international community to recognize Crimea that you're showing there, and the Crimea as part of Russia, legally, formally, internationally recognized part of Russia. That's what the Russians want. The Ukrainians will never give that. The Ukrainians will acknowledge, grudgingly, through gritted teeth, David, that the Russians occupy 19% of their country, including Donbass and Crimea. 19% of their country. Their other 81% is not occupied. They want to keep it that way. The Ukrainians eventually want to take back that 19%. So they're not willing to formally acknowledge or agree or accept that those lost territories are lost forever. They are not willing. They say they're going to get it back. And Dave, one last thing, just on that point, they remember after World War II, that West Germany was divided. That Germany was divided into West Germany and East Germany, and the West Germans never gave up hope of reuniting with East Germany, even though the Soviet Union at the time dominated East Germany. And the Ukrainians remember that. And the Ukrainians will not give up hope of taking back eventually Crimea and Donbass.
Okay, so they might not budge on that. I'm wondering then, in terms of this so-called reassurance force, this NATO Article 5-like sort of pledge that has been thrown around, what would that look like to you, Ambassador?
Yvonne, a great question. And this was a big issue today, a very big issue, because the Europeans are really stepping up. I mentioned that they're here, and they really made an effort for all of these senior folks to get here on very little notice. They're stepping up, and one of the ways that they're stepping up is through this security guarantee idea. And there, you've got people in particular, the British and the French are taking the lead on something they're calling the Coalition of the Willing. Yvonne, you've been probably talking about this. The Coalition of the Willing, it's some 30 nations, but led by the French and the Brits, that would apparently be willing or prepared to put troops on the ground, put military forces on the ground in Ukraine to be sure that after a ceasefire, the Russians don't invade again. And that's what the Ukrainians are worried about. The Ukrainians are worried about if there is a ceasefire, then the Russians will take advantage of it and invade again. By the way, going back to the first question, they're also worried that the Russians want to take the high ground in Donbass, in Donetsk, in the eastern part of the country that the Ukrainians have been defending for 3.5 years. The Russians now want that, and they want the Ukrainians just to give it up, So all to say that the security guarantee is really an important component of this.
Well, do you think the Russians, Vladimir Putin, signed off on? Do you think he'd be okay with those security guarantees?
No, and neither do I think that he has any business in talking about security guarantees for the Ukrainians. This is not the security guarantee is between Ukraine and Europe and the United States and NATO, and it has nothing to do with well, it has to do with Russia. It's designed to defend against Russia. It's designed to keep Russia out of Ukraine. So it makes no sense to me to be talking to the Russians, or even thinking that the Russians have anything to say interesting about a security guarantee or a coalition of the willing or a reassurance force on the ground in Ukraine. The Russians don't get to say about it. No vetoes. They don't have an ability to stop that.
Right, but wouldn't that be a precondition, though, to a path towards a peace deal, for example? We know that Vladimir Putin did not want NATO at its border, right? And effectively, a security guarantee might look like that. That's the reason I'm asking you as well. Do you think he walked away from that meeting with Donald Trump having okayed that idea of a security guarantee?
David, NATO on Russia's border, it's been there for a long time. And it just got about 800 miles longer with Finland's coming into NATO. It didn't bother Putin when Finland and Sweden joined NATO. It's not about NATO. It's about Putin's desire, his obsession with controlling, eliminating, absorbing Ukraine. And that's not... it's not contested. President Putin says that he says that there's no such thing as Ukraine, that Ukraine as a nation doesn't exist. So that's his rationale for trying to absorb it, to invade it, to take it over. So it's not NATO. It is not NATO. It's his obsession with Ukraine.
Ambassador, appreciate the time. Thank you so much for joining us. William Taylor there, former U.S. ambassador to Ukraine. Plenty more ahead. This is Bloomberg. Well, now to a Bloomberg scoop. We've learned that Shein is considering moving its base back to China to help sway authorities to sign off on its plans to go public in Hong Kong. Let's get to our Asia Global Business Managing Editor, Rachel Cheng. She has more details of this scoop. And Rachel, what more do we know at this point?
Right. I mean, this is a really significant piece of new information that we've uncovered. We do know that Shein really has been in a bind in terms of trying to get this IPO off the ground. It hasn't managed to get regulatory approval in New York or London. Now it's trying to IPO in Hong Kong, where that approval from China is all the more necessary. But what we also know is that Chinese regulators really see, Shein's efforts to sort of pretend that, not pretend, but sort of not be perceived as a Chinese company. It moved its headquarters to Singapore in 2021. What that means is, China does not get any of its taxation. China does not have oversight of the data that it collects. And we do know that these are issues that, with the regulator has held up the approval for them to go public. So, Shein really, this would be a big Hail Mary move for them. It would be a huge change to their structure moving back to China, but it might be the only way that they can IPO.
And Rachel, do we have a timetable for this? Do we know when?
We don't. We know that the talks are very preliminary. The work is preliminary. We do not know for sure that they'll move forward with it, but we do know that Shein really does not have many options right now. Its valuation in private markets has also fallen quite a bit because its business is facing a lot of headwinds. The loss of the de minimis waiver that allowed its parcels to go to U.S. consumers duty-free, that's under Trump's tariff barrage. That has really affected its business as well. So Shein is really looking for a way now to get those initial investors the exit that it needs before their business conditions deteriorate even more.
Rachel, thank you so much. Rachel Chang there with our scoop, our Asia Global Business Managing Editor there in the scoop on Shein weighing its move back to China. Speaking of a quick turn of events like the weather outside, markets are now in the red. As you can see, CSI Shanghai Comp now flat for the day. Hang Seng, well, let's call it pretty much flat on all the major benchmarks. About an hour into the cash market session. Plenty more ahead here, including a wrap of the morning session in Japan, a look ahead to the 20-year bond auction, plus plenty more ahead. keep it here. This is the China Show. Right, welcome back, and we're about a minute to the Japanese lunch break. Live view of Tokyo, where again it's envy all around if you're watching from Hong Kong. You saw Shanghai. Tokyo seems to be fairly okay with the lack of rain and liquidity, which really is both a blessing and a problem here in Hong Kong as far as the weather, but the markets is a blessing, certainly. Nikkei 225 down about 1%. Call it nothing. Some of the key crosses there, as you can see, the yen is on the stronger side of things. We'll see what the bond auction looks like, and might the yen be actually the best position to gain ahead of or around and even after Jackson Hole. 1-year yield in Japan, 66. 20-year government bonds on your screens, 312 right now on, 258 rather. 259 on that specific tenor going into that bond sale in about an hour from now.
All right, some other corporate stories that we're tracking for you today. SoftBank has agreed to buy $2 billion of Intel stock as part of its chip ambitions. The Japanese firm will pay $23 a share, a small discount to Intel's last close. And the move delivers a strong vote of confidence in the chip maker. Intel is looking to prove itself as a tech leader again after falling behind chip rivals. Tech firm Meitu's first-half profit jumped 31% to 397 million renminbi, beating last year's 303 million. Revenue climbed 12%, while gross margins expanded nearly 74%. Monthly active users also rose to 280 million. That's up almost 9%. Analysts remain bullish with 17 buys and no holder sells on the stock, with stock down some 2.7%, but still one of the key performers here in Hong Kong of late. Pharma giant Sino Biopharma saw net income climb 12% in the first half to 3.4 billion yuan. That's compared with 3 billion a year ago. Revenue rose 11%. Now, the firm also boosted its interim dividend to 5 Hong Kong cents a share. That's up from 3 last year.
Leapmotor reported earnings that showed its net income on a GAAP basis, specifically swinging back into profits, 33 million or so renminbi in the first half. We spoke, in fact, earlier on with the co-president, Michael Wu, who told us that the profit margins are healthy, and they're also bumping up or upgrading their sales forecasts for the year. Have a look.
We've had a quite good result. As we always been saying, we're in the long-term business and we're on track. So as you pointed out, the second quarter and the first half, we actually turned a significant milestone to turn the profitability. And also our sales volume, 221,000 in the first half. That's over 150% growth, ranking the number one among the startup peers for the first half. And also sales in July, we achieved more than 50,000 sales volume. Again, ranking number one among the startup peers, being the 5th consecutive month achieving that number one. And the revenue growth more than 170%. We're both operating cash flow, free cash flow positive, and not only positive but also a significant growth from the last period. So gross margin also quite healthy. We average gross profit margin was 14% for the first half, compared to we barely turned positive in the last year in the same period. So based on the strong performance, again, we're on track for the whole year. We have upgraded some of the projections. Sales volume, we upgraded from 500 to 600,000 units to now 580 to 650,000 units for this year. And we'll maintain the path to have the quite reasonable gross margin, around 14% to 15%. Again, for the whole year, we target to achieve profit in the range of 500 to 1 billion RMBs.
Okay, on track. Wow. I mean, you made 30 million renminbi in the first half. I'm just wondering, if you're talking about 500 million to a billion, when can you actually transition to long-term profitability, Michael?
Again, being on track is the way we achieve long-term profitability. for 2026, we will target to sell more than 1 million cars in total. And by 2027, we would target to sell close to 2 million cars. So we're executing around that path. And with that, obviously, the profitability will improve, given our business nature being high operating leverage. So for 2026, the profitability could be in multiple billions in RMB.
Okay, yeah. Well, just to recap that, Michael, wow, these are very big numbers here. So 1 million is the sales target for 2027. Correct me if I'm wrong, by the way. 2 million for 2028. How are you then, 2026, how are you aligning your production capacity then to be able to then reach those goals if demand, of course, cooperates?
Yes, we plan our business alongside in terms of production. By end of this year, we'll have the production capacity more than 1 million units. So it's always being planned in parallel.
I'm just wondering, there's a whole government campaign now, Michael, that is talking a little bit more about how to end all this crazy competition in the EV space here right now. Maybe can you talk a bit more about anti-involution, this drive here? Does that change your pricing strategy in any way?
No, actually, this, as you mentioned, this new, guidance or the new industry self-constraint, way, which is good. To make sure, while the competition being fierce, we don't go from extreme to this extreme to the other extreme, which is quite healthy in long term. So in terms of our strategy, it doesn't change anything because we produce products, we bring the product to the market with a very good feature, very good value to our targeted consumers. At the same time, as we grow our volume, as we grow our gross profit margin, we also continue to drive down the cost, leveraging on what we do the best, which is we have a fully vertically integrated business model with all the key electronic and electric parts and components. We're the tier one suppliers to ourselves. So we do all of this in parallel. And the price, our pricing allows us to have, as we mentioned, double-digit gross margin, yet can provide the best, competitive products to the industry. So I guess it's about competition and competitiveness rather than kind of unhealthy competition.
Zhejiang Leapmotor Technology Co-President Michael Wu there speaking to us a little bit earlier on. And we got more auto earnings coming up tomorrow on the China Show. We'll have Xpeng's Vice Chairman and President Brian Gu take us through their earnings and what's ahead for the company. This is Bloomberg. We got more earnings to tell you about. Investors looking ahead to results from Xiaomi following a rally that has driven its market value up $120 billion in the past year. Let's bring in our China correspondent, Min Lo, with a preview. There seems to be a lot of concerns over the smartphone business, the core business.
Yes, the smartphone business contributes to 40% of revenue, and there's concern that there has been so much headwinds, right? Despite those consumer subsidies, there's worry that, that momentum is going to fade off, plus the intense competition with some of the domestic competitors like Huawei and the like. There's been intense price competition that is eating into margins, especially the kind of promotions that we saw during that June shopping festival. And then you add to that the growing cost of chips, as well as its overseas expansion into markets like India. That's where it's seeing its market share falling, Apple overtaking it in the first quarter. So that's the concern here. Even though there's been so much exuberance over its EV business, right? We are seeing delivery lead times getting longer, a sign that perhaps there are capacity constraints, which is a good problem to have. But the questions now about whether those EV demand and the sales growth there is able to offset some of the slowdown that we are seeing in the smartphone business.
Yeah, and the stock itself, right? Does it justify this sort of crazy stock move we've seen, given the fact that it's already more expensive than the likes of BYD, I believe. So let's talk about PopMart. That's obviously going to be a popular one for many in the market. What are we expecting there?
Yeah, we had the preliminary report from the company back in June, and the company said that they are looking at potentially around 350% increase in profits and 200% increase in revenue, which is a very remarkable number. And I think what really stands out is its profit margins. We're looking at about 68% profit margins according to analyst estimates, and this is head and shoulders above any other, Chinese companies with international reach. You look at Miniso, for example, another retailer, they're looking at margins of about 45%. You look at some of the electronic firms, the consumer firms, including BYD, Xiaomi, they're looking at 20% margins, so 68%. That's an eye-watering amount of margins that many companies would be jealous of. But the other thing that really stood out to me is the overseas expansion. The CEO Wang Ning said in a People's Daily interview that they are expecting North America expansion to surpass its Southeast Asia expansion, which is quite interesting because a lot of its peers, you look at Chargy and a lot of these Chinese retailers, they tend to expand more in Southeast Asia first before going to the West. And I think Pop Mart really benefits from the fact that toys are still a relatively not sensitive sector, right? It's not facing export controls in the likes of the US and the EU, and that's supporting its growth. We are looking at 900% growth in the US market in the first quarter, 600% growth in Europe in the first quarter as well, 100% growth in China. So that overseas expansion really overshadowing its growth in the China market.
You did that whole hit without mentioning Labubus.
Yes,
Labubus.
I forgot about that.
Yes, of course. That is what's driving all this, right? I mean,
now I'm upset. You had to bring it up.
There is a number for that. 10 million, I believe, is the number of Labubus expected to have been sold, I think, in the first half.
Wow.
But I think, the main sort of downside risk that some analysts are saying is that there is this over-reliance on Labubus. And whether or not, Pop Mart can create more IPs that could, replicate the kind of success that we've seen here.
Yeah.
That was the Hello Kitty analogy that was brought up a few days back, right? And how Sanrio was able to pivot away from just a single focus on a single product concentration, I guess.
Yeah.
But there are still some other cute ones like Crybaby, Twinkle Twinkle.
Yes, there's a lot.
David has exited the chat.
All right. And then thank you, our China correspondent there with an update on what to expect out of Pop Mart as well as Xiaomi here this morning. In terms of more earnings to tell you about, we talked about Xpeng, we talked about Xiaomi, Pop Mart. There's plenty more still in that list, right? So Wuxi Bio paying on Good Doctor in the biotech space. You got Sunny Optical, an Apple supplier, Kunlun Energy, China Resources Beer, and Fuyao Glass are next there. But you've been tracking some of these, what we've seen so far. And what's the report card looking like so far, Dave?
Yeah, here's the pie chart for you by number of companies. You have 28 have come in ahead of forecast, 25, so slightly below. Let's call it the even split, and let's see, because it's early days still, have missed forecast so far. What's telling, though, is the market reaction has been mostly negative, even when you tend to get beats on the first day after they reported, which I think is a good indication of, say, Leapmotor. Today is a very good example of a massive rally, and then we're seeing shares come off post the earnings release, which is unsurprising anyway. Coming up, speaking of earnings and speaking of a stock decline, so CSL, massive company, of course, in Australia. Paul McKenzie, the CEO and Managing Director, will be coming on very, very shortly to talk us through this major announcement of a spinoff, plus really what to make of the market reaction adverse market reaction we are seeing today. That's coming up next. This is Bloomberg. Right, welcome back. We're just going into the hour and 15-minute mark, cash markets, as you can see. So we've been effectively flat, nothing much happening as far as Hong Kong goes. I mean, when you look at sort of what's driving the index itself, it's certainly on one end, and you see it on your screens. Tech is the main drag today. On the opposite side, though, is you have the banks, and again, that's another popular trade, which is perhaps also why the onshore markets are doing slightly better on an index constituency, I guess, conversation. Shanghai Comp CSI was flat, in fact, was lower earlier on, and now, of course, moving more towards the upside there. Right. Other things taking place. You had a massive move up in Hibor yesterday. In fact, we had a very big move on Friday. And then we had an even bigger move on Monday. It's certainly something to watch in about 30 minutes' time once we do get that update there. So rightmost side of your screens, of course, we're coming off a low of the day. 50 basis points is the biggest single-day jump in about 17 years, which is interesting and unsurprising and certainly related to the move we're seeing right now in the dollar Hong Kong market, where we're now trading on the stronger end of the two halves here, right? So earlier on, we did take out a few seconds ago, we did take out that 780 handle. We're slightly above that at the moment. So let's call it at the midpoint of the trading range given the peg taking place. Very quickly, we're looking at long JGBs. We have a bond auction coming through, 20-year bond auction. I think we are now looking at about can we get that up, please, if we can? The 20-year bond auction, please, if we can, and 20-year JGBs. We are, of course, in the middle of the lunch break for cash market session. There we go. And we're now at about let's call it 259 on the 20-year yield. Okay, so other things taking place as well. So we're in the thick of earnings season in Australia, so lots of big conversations coming up. In the next hour, you have the likes of BHP will be joining us, and certainly the questions there around valuations. We're nearest, the priciest on PE, going back, I think, to 2021 as far as BHP goes. So that's point number one. And, of course, the other big movers coming through as well. I mean, yesterday we just had a conversation with Lend-Lease on their earnings. And, of course, we're going into this big one coming soon on CSL, of course, and the big spin-off there.
Yeah, some big news that really came through, on not just on the earnings side of things. I mean, the earnings side was actually decent, in fact, good. But it was this massive restructuring that they've just laid out here. So they're spinning off the Seqirus vaccine business. They're cutting costs by around $500 million a year as part of this restructuring plan. So let's talk about this a little bit more. CSL, the largest pharmaceutical company in Australia, those shares are falling this morning. And the slide that we've seen is one of the worst days on record. That's after the firm reported disappointing earnings, announced plans to spin off its vaccine business. A lot to unpack, really, from Melbourne. Let's bring in Paul McKenzie, CSL's CEO and Managing Director. He joins us now. Paul, thank you so much for the time. I got to get your take on the share price and what's going on right now. Yeah, are you surprised by this reaction?
Well, look, we're really focused on driving shareholder value and continuing to grow demand for our products around the world. And I think if you look at the comprehensive package we laid out today, it's really about becoming match fit and delivering the company to the future, right? So we had terrific earnings in fiscal year 25, 14% growth above guidance, which was very strong. So we'll continue to work through with our investors so that they understand the completeness of the package and the goals, and we'll see where we end up.
Yeah, that's it. Yeah, Paul, thank you so much for the clarification there, because the market seems to be, well, I think for one, we all know, of course, the short-sightedness element of markets, but also just to mention, since you talked about the business, I'm looking at several commentary coming through from analysts here, and, some of the core business, for example, did get a lift from the low tax regime. I wonder if you could comment on that, or is there something beyond just the low tax that was able to lift that number for you, Paul?
No, I think it was really our execution to plan on all our margin levers and operational excellence across the board, right? So if you look at we rolled out new technology and on our plasmapheresis suites, which was extremely important, getting us yield and getting us more from every donor and every dollar we spend per donor. We've increased our yield in our manufacturing facilities. We've launched a new product in Dembry, which will be the new standard of care in HAE, hereditary angioedema. So we have lots of levers that we're pulling that both hope to drive top-line growth as well as margin growth, and they're to plan.
I was going to ask you about the Seqirus business, which you decided to spin off. Yeah. This, obviously, you faced headwinds, obviously, with this business, obviously with what's going on in the U.S. right now and the Trump administration, where you have the CDC overhauling vaccines. RFK Jr. also is in his anti-vaccine sort of stance. How is CSL addressing any of these concerns?
Yeah, I think actually if you look at flu, which is where we play the biggest, we're the global leader in influenza as well as pandemic preparedness. It really is a great story for us right now at Seqirus, and the timing for this demerger was right. Flu had a 15-year high for hospitalizations and deaths last year, and we just recently got in the U.S. the preferential ACIP recommendation, and as of this morning, the head of the HHS supported that recommendation. So flu's here to stay, and we have a differentiated portfolio. We've moved away from egg, to cell-based and adjuvanted technologies, and we're well positioned. So as Seqirus now with CSL, we've capitalized it well. We've just completed a new manufacturing facility here in Melbourne, and as well as we've completed the geographic expansion into Germany and France, where we also got a preferential recommendation for flu. So we think Seqirus is really well positioned to what we see as a market that will continue return to growth as U.S. vaccination fatigue, in the 18 to 64 category fades and we move back to more normal course of business. So we think we're in good position with this demerger, and the timing's right for us.
Paul, I guess on the demerger, more on that, do you have a number in mind, a rough number in mind, how much you want to fetch for this business? How much do you think it's valued?
Well, look, again, I think of the shareholders, we're demerging it to our CSL shareholders, and then we'll see where the market goes. But flu is a $7 billion industry. We are strategically well placed with our differentiated portfolio, as well as our pandemic preparedness. We have contracts with over 20 countries. The avian flu, which is circulating still, we got 90% of the majority of the contracts around the world for it. So, I think the value's there, and obviously the market will determine that value for us.
And the Trump administration, the president has called for major drug manufacturers to lower prices in the U.S. I know CSL was not among those companies that received letters, Paul, but I'm wondering if you're feeling the pressure to have to lower your prices.
No, we've never been a company that's taken price. We've always looked at CPI, and we've always made sure, we're a bit different than a lot of other pharmaceutical companies. We have a lot of cost in our raw material acquisition in plasma, which is all derived in the U.S., right? So we collect all of our plasma. We have major U.S. operations, and that's where our active pharmaceutical ingredient comes in. So that's where the tariffs, the impact on tariffs on us, and as well as most favored nation pricing, we'll see how the policies go, but it's a bit different for us than it is the other pharmaceutical companies.
Paul, thank you so much for taking the time. Let's speak again soon, and hopefully before that next step, of course, in the demerging. Of course, I do understand as well you have planned a share buyback and hopefully addresses some of the concerns in the market these days, because it's quite a bad day, at least one-day reaction. Paul McKenzie, thank you so much, CEO, Managing Director there at CSL, joining us live post their earnings. Right, coming through as well in the next hour of Bloomberg Television, we have tomorrow C-suite interviews coming up out of Australia. BHP and Woodside and their respective bosses will be helping us understand and debrief the earnings plus the outlook for both companies, and also obviously the sector as a whole. Before we go, just a look at markets, and about 90 minutes into the session, and things are looking like this. So we just coming off, as you can see, with session highs, and I guess we have to wait another day before we take out those October highs. But, we certainly have a full afternoon session ahead, 30 minutes to the morning session break. We're flat in the CSI 300. We're still looking at things like turnover, and of course, one to watch is Hibor going into the next hour of Bloomberg Television. So we will see you all tomorrow. That's it from us here on The China Show. Good day, good morning. Keep safe, keep dry.